This is Barry Norman on behalf of ETX, and welcome to our class on understanding the economics calendar. Now, ETX is a regulated provider, and I'm therefore required to give you a risk warning, so let me read that and get it out of the way. Now, I'll read the first paragraph with you, and I'd appreciate if you all can read all three paragraphs. Trading in the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risks or seek independent advice if necessary. Now, ETX is a fast-growing financial services company based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority, and our parent company, Monaco London, is a member firm of the London Stock Exchange. As you know, when you trade with ETX, you can use our Trader Pro, our web-based trading platform, or you can download the ETX MT4 platform, or use both. Now, if you haven't used our online Trader Pro platform, you should check it out. We've just, a couple months ago, launched an all-new version, and you can just simply locate on your trading platform the upper right corner, and you can try the new platform, or you can go back to the old platform if you're more comfortable there. Now, tonight's class is being recorded, and you can access a recorded version of this class in about 24 hours by using the same link you used to come to tonight's class. Now, tonight we're going to be talking about the economics calendar, what it's for, what it does, how to use it, and how to build what we call market neutral, market positive, and market negative. Now, the economics calendar is published daily, so to speak. It's available online, and it has all the events for each day, but it's published way ahead of time. But the only thing of any crucial importance are the events that are actually the data is being released at the moment. Now, it used to be years ago, it was very hard to get this data, and we could get it as the trading public, usually hours later or from that Wall Street Journal, but we couldn't get it as fast as the big traders. Today, because of the internet and direct feeds, whether we're getting it from FX Empire, whether we're getting it from investing.com, whether we're using a Forex Street economics count, we're getting them just as fast as everybody else because they come directly out through feeds directly into the calendars. So don't think that a hedge fund's getting the data before you. Maybe a couple seconds, but not any faster than that before you. Now, all the important news in trading the Forex market is programmed months in advance. You'll know when the ECB is meeting to discuss policy. You'll know what events are coming out. You'll know what countries are coming out for. And about a week before, you'll know what's expected. Now, on your screen, we see the updated calendar of just the top events on the calendar through next Friday. And these are only the top level events for the major economies. A calendar, I mean, there are so many events you would be inundated, you couldn't get through them all. So the only ones that we're really concerned with when we're trading CFD and Forex are those events that have an effect on the financial markets. Now, before we can actually learn how to trade from the calendar, we need to learn how to read one. And they're all virtually the same. So let's go over and take a look at a calendar, and let's figure out how to read it, what it does, how to set it up, and how to use it. So let me pop a calendar up on your screen. And there we go. And we are looking at the up-to-date calendar from FX Street. Like I said, you can get them all over the internet. They're all virtually the same. There are some graphic differences, some creative differences. They all get their data fed in from the same sources, and all the events are the same for everybody. Now, the first thing we should do when we're looking at a calendar is make sure we have it set in our local time zone. That is crucially important because you don't want to make a mistake and miss an event or miss it, decide you're going to trade something after an event or before an event and not realize you have it several hours differently. So just like your charts, your calendar should be set to your home time zone. So you know exactly what is happening, where it's happening, when it's happening. Because even if you're not using the economics calendar to trade an asset, If you don't realize an event is about to take place, like a central bank meeting or a major inflation report or housing report, you're that report could cause a fluke and some volatility in whatever asset you were trading for that, even sometimes for a short minute or two, but it can be enough to stop you out in your trade or enough to make your trade move against you. So you should always be aware of all the events on the calendar. The other thing with the calendar is we need to make it so it's reasonable. So if we were to look at the calendar without filtering down the countries and the events that were important to us and the level of events, we would be inundated. If I just have the major economies clicked off now, but if I was going to click up all of the events and then take all of the level events, regardless of how important they are overall, and put this on my calendar, all of a sudden, that little thing we were looking at becomes this long. It's too much for us to be able to deal with as traders. Now, the nice thing is all the economic events are filtered, and these are standard filters or standard variables. And we call these either volatility levels. They're actually called tier levels. Some call them impact levels. Some call them importance levels. Okay. All economic events are rated in this grouping of 1, 2, and 3. Top tier events, the ones that are crucially important to the markets, that also have the importance of shaking up the market, are considered level 3 events. And this is where we vary. FX Street here uses colors instead of numbers. So they've assigned these yellow, orange, and red colors. Red being the highest volatility, orange being second level, yellow being third level, and gray events being events that have no volatility or no effect on the market or aren't expected, like the G20 summit. Okay, doesn't have an effect on the market, but it's still an important event. So it'll be on your calendar or like we can see here with holidays. So we can see right here, we have the US and Canadian Labor Day this next weekend, and the next Monday, the markets are closed. So they're just gray events. Gray means that they are not rated events. Okay. We can see here for New Zealand terms of trade, and the event level isn't based on the global markets. It's not based on an asset. It's how important is that event to that local economy. So we should always be aware of level 1 and level 2, or level 2 and level 3 events. So if we were to clear up our calendar and just take level 2 and level 3, we can see it gets down to being fairly reasonable. Okay, the longest day, as we can see, Thursday. Okay, again, it depends on how many countries you're monitoring. I mean, if you're not trading the Australian dollar or not trading some minerals, out of commodities out of Australia, it's not important to you. If you're not trading anything in Europe, you don't need to know what the Swiss results are. But overall, you need to know what Canada is doing, US is doing, what the overall Eurozone events are doing, just like you don't need all the small countries. A piece of data out of Spain or a piece of data out of Portugal doesn't really have an effect on the value of the euro. So what we look at are the major events out of Germany and the overall Eurozone. So we can see these are Eurozone events. These are not individual countries. Okay. If we were looking when it's individual countries, we'll see how it has GBP. Here is the euro. This is the total for all the Eurozone, not for an individual country. The only country we're concerned with in the Eurozone is Germany, because German data because Germany is the biggest economy, can have an effect on the markets. But you have to decide. It's all based on your trading and what you're doing. If you're trading a stock on the Spanish exchange, then it might be important to you. Okay. But you have to be aware of all of these events because they will shift the markets somewhat. So once you've set your filters, and tonight for class, we are going to focus on a couple events which are going on next Friday, a week from Friday. Now, we're not talking about these events for you to trade them. It is one of the most important events, and it's the U.S. jobs report, and it's the best report for showing you how to analyze this data. But we're not going to be discussing what you should trade and how you should trade it. Okay. But that's an event that we can focus in on. So right now, I'm going to get rid of all the level 1 and level 2 events, just leave it with level 3. So again, I'm going to go to my filters. And just go to level 3 events. Okay, now, this is just because it makes it easier for us to look at stuff tonight. Now let's talk about the data that is contained within the calendar. The first you're going to get is the time release of the data. Now, all of this information comes from feeds, data feeds from the source. Therefore, everybody or every calendar has the same information. There are some parts of this data, and I'm not a computer guy, so I can't tell you the computer development background information, but there's parts of this data that can be the creative department and development can make them look a little bit different. So FX Street can control the columns and the order of the columns. They can use color instead of like FX investing.com uses bullheads. They use 1, 2, and 3 bullheads. So their 3 bullheads is the same as red because the data, the computer is just automatically told. If it comes in 3, make it red here. If it comes in 3 over there, get 3 bullheads. Some use explanation points, some use flags, but it's still whatever they've decided what the 3 looks like. So understand, and then the rest of it's creative. They can decide the background and how all the stuff works. Now, so generally, you get the time. Then you'll get the event. Okay, and all of these events and all the calendars should be the same. There are some calendars that pick up more events because all the events are fed out by these feeds. It just depends on the person doing the development, the creative, how much stuff they're bringing into the calendar. Okay, so you need to find which one you're more comfortable with. I use FX Street because I like it, but you can use investing.com, FX Factory. A lot of brands and brokers have them on their website, but because they don't want to create them and they're not keeping all the data in, they're usually using an API or something else to pick up somebody else's calendar. Now, the farther you're away from the source, the slower the feed comes to you, and it's only by a couple seconds. But depending on who the brand or the broker is using, it might be delayed a second or 2 or 3 seconds. No, so it's like FX Street will allow its members, and you can pay to put their calendar on your site. And then you can adjust it to fit your site colors and everything else. So just keep that in mind. Now, the thing about this is almost every event repeats itself every month or every week. Like US unemployment that's released every Thursday is released Thursday after Thursday after Thursday. The weekly oil report in the US, the EIA report is released every Wednesday. If it's a monthly report, it's released every month, and they're on the calendar over and over. So you don't have to master the calendar today. And believe me, every country releases virtually the same data based on that country. They call it something different. Like in the jobs report in the US, it's called the non-farms payroll report. The jobs report in Australia is called the jobs report. The jobs report in the UK is called the claimant count. They all contain the same piece of information for that country, but it just depends on the language in the country and how the data came. The US is called a non-farms payroll report because in the US, the Labor Department was responsible for all jobs and keeping all the statistics for everything but farming jobs. That was the Department of Agriculture. And so It was named, way back when, before trading and before futures and before CFDs and before finances and online trading. It was named non-farm because it had everything but the farm jobs in there. Okay, today we just refer to it as the jobs report, the U.S. jobs report. Now, after we go from there, we're going to go over to the right side and some very important columns. Now, this column here, which is called previous, is simply the number that was released the last time this report was generated. So the last time the RBA, this the Reserve Bank of Australia, met, interest rates were at 1.5%. Okay. The gross domestic product in Australia was 1.0% last month when this report was released. GDP for us, the Eurozone, was at 0.4%. It's just a number that came out last. So the minute the report comes out for this month, it goes on for the previous for next month. So it's on the calendars way ahead of time. The next column is a very important column. This is called consensus. It can be called forecast. It can be called survey. It can be called projection. This is about the only column that doesn't come from a direct data feed. The reason being is most of these reports are governmental reports. The government does not project what they think a report's going to come out of. It's the report comes out, they feed you the data with the results, and that's it. So, as you know, a lot of times you're reading in Wall Street Journal, you're reading in CNN, you're reading in the big financial papers, Bloomberg, that our survey of 42 manufacturers, project managers expect the report to come out this, or our 100 analysts have said this is the result. This is only a estimation. It's the market expectation. Like Thomson Reuters releases a lot of these numbers, and so does Bloomberg for all the reports, but it's only their own in-house analysis. It's just a poll. It was like before Brexit, all the polls were releasing polling data based on surveys of what they expected it would happen. That's what we get here under forecast, consensus, expectation, forecast. And then when the actual data comes out, it goes in here into the release box. Okay, so we're going to go and we're going to look at let's go. I want to show you okay, here is a report that was released today for the US. It was the Case-Shiller's Home Price Index. It's a level 2 report. Doesn't make a difference at this point. What we got was our previous, which was what it was released when it was last month, what the market was expecting, and this was the only number we had up until 1300 today, and the actual number came out. So what we got was 6.3% when we were expecting 6.5. The reason it's in red is anytime the actual is less than the expectation, it's in red. If it's better than the expectation, it is in green. Now, when this report is released, something else can happen. Okay. In this case, it didn't happen, but you need to be aware of it. See this previous number? This number isn't etched in stone. It's the number that this report was when it was released last time. But because these are analytical reports based on lots of data and mathematics, that throughout the month, all the statisticians for the agency releasing are constantly updating their data, checking their data, breaking it down, verifying sometimes not everything came in. And if there's a revision, and they will revise these reports because they want the reports to be accurate. So if over that month's period there was a revision, they will, at the time of the release of this report, they will issue a revision of this report. So anytime you see the previous in red or green, you know it was a revised upward or downward. And all the calendars, if you just hover over top the number, will tell you what it was revised from. So you can see where it was and what it was revised to, because this becomes important down the road. Because say, for instance, you're expecting 100,000 new home sales this month. Okay, last month you had 90,000 new home sales. Now, this month's home sales missed expectation and came in at 95,000. Well, that means it was 5,000 off, and that was a bad number. But at the same time, they got an upward revision to last month of 10,000 and upward revision moving to 100,000. Well, what that means is this month wasn't bad. It was because last month was revised forward, and when you did the expectation for this month, you took into account what actually happened last month, and you found out, okay, well, last month was better than expected. So this month we overestimated because we thought it was going to be a higher number to take into account for the sales didn't happen last month. So you have to take into account, okay, we missed a little bit here, but we had a revision upward to make last month a lot better than we expected. So keep that in mind, because a lot of times the reports overall affect the economy on a cumulative basis, not individual month basis. You know, a real economic analyst will look at what the quarter did, not what a month did. But the financial markets, especially the currency and CFD markets, react to the monthly reports. So for instance, a year ago, over a year ago now, time does go by fast, we had an exceptionally good jobs report that was like 40,000 more jobs than were expected. Then the next, so that was a very good report. The next month we had another good report with 30,000 more jobs than were expected. The next month we had a really bad report, and that report missed by 50,000 jobs. Well, the instant reaction was, you know, a drop in dollar, up in gold, but it subsided very quickly because when you looked at it, the 3 months together were better than the quarter was expecting. And economists look at quarters. And then the next month, not only did we get a good jobs report, we had a revision to the prior quarter, the prior month, that moved the prior month from that very bad month up to a very good, to a good month, because it happened to fall over something. Sometimes, you know, it falls over the weeks and the months don't coincide. And so the reports don't get all in, or sometimes you have a big holiday week, especially Christmas, New Year, because so many people are on vacation that the people submitting the data in the payroll departments or the accountant don't get it into the government agencies on time. Memorial weekend in the US, Labor Day weekend. And what happens is this data doesn't get in on time. So we have to keep that in mind. So remember to keep this in mind. Now, today we had this release of the S&P Case-Shiller Home Price Index. Now, whether you're sitting in London, you're sitting in Ireland, you're sitting in Scotland, you're sitting in Australia, okay, you have no idea what this is trying to be. Well, all of the calendars will either have a little information box, or you can click on their line and it's going to open up an information report. So now, as you can see, we clicked on it and it tells us exactly what this report is and what or why it should be important. Now, again, depending on the site you're using, they also give you a whole bunch of charts. One of the reasons I like FX Street is they've developed their own information systems. So you can see down below, you get the actual deviation. This is how you can see all the months that have led up to it, the prior report, what the consensus was, what the deviation was, and you can see the overall run of that report. You also get a true range. You can get the volatility ratio, see how volatile that report is and how it affects an asset, okay? And you get a deviation report. So they give you lots of detailed information. Other ones give you general. They'll all give you the actual reports and the consensus and the chart. I happen to like the deviation because you can also set it how it affected the particular assets. So I like their report system, but I've learned to use their reports. You'd have to decide what calendar you want to use. Now, I'm going to tell you a story. that'll help clarify the actual, the consensus, the previous, and help you understand how it affects how an asset moves. So let's go back to my PowerPoint. And I'm going to tell you the story of your kids and their report cards. Now, you have a son. No, he's a teenager. He's a good kid. Doesn't get in trouble. You know, he treats you nice. He talks to you respectfully. He's a generally good kid, and you trust him. So you're sitting down at Sunday dinner, and you say to your kid, well, kiddo, report cards are due Wednesday. How do you think you did? Okay. It's like the economics calendar. You know an event is due on Wednesday, and your son responds to you, well, you know, Mom and Dad, last semester I brought you home 4 C's and 4 C pluses. They say, yes, we know that was last semester. That's the previous. Now, the nice thing about the economics calendar, just like the report card, it is just information. Nothing has been there, has been analyzed, revised, revoked. It is straight information. So you know that a C plus is all right, and you know a C plus and a C is average. Okay? There's nothing been taken into account how the other kids in school did, whatever did. This is just a grade. So is the economics count. The economics count isn't taking into any analysis, any other consideration. The jobs report is the number of jobs created, regardless of how good or bad the economy is. It's a number. Now, so he said, Mom and Dad, you remember last quarter, I brought you home 4 C's and 4 C pluses. They said, yep. So Dad says, well, how do you think you're going to do this time? Well, because your son is pretty reliable, you're going to believe what he tells you. And he said, and he, you know, he kind of knows, you know, he's aware of his grades. You know, he does all right in school. He says, well, Mom and Dad, I think I did a little bit better. Maybe I'll bring you home all C pluses this semester. Okay. So as parents, you do the good thing. You give him a lecture on spending too much time on social media, too much time playing soccer. He needs a crack on those grades if he wants to get a scholarship and into university. But that's just what you do as parents. It's not going to affect his grades. Now, he's told you he's going to bring you home better than he got last time. So you're not going to yell at him. You're not going to be mad with him. You know, you give him his little pep talk, but all C pluses isn't so bad. And at least he's improved. So you're happy, parents. Now, come Wednesday, kid comes home with the report card. He comes running in the front door, hands it to you, and runs out the back door. Now, you open up the envelope, and guess what? The kid brought you home straight B's. You're ecstatic. You're thrilled. Why? Because it's much better than you expected. Not better than what it was last semester. It's better than what you expected because you're a human being and you react like a human being. If he brought you home all C pluses, you'd be all right, but it wouldn't have been much of a reaction because it was what you were expecting. If he brought you home 6 C pluses and 1 C, or 6 C pluses and 1 B, still not much of a reaction because it was close to the expectations. So what we have to do is be able to determine what the reaction will be between expectation and reality. Because also, we're all here because we trade CFDs and Forex, which are short-term trading. We're basically a modified type of day trader. Because what will happen is if he brought you home all C pluses, the markets wouldn't have reacted, but the economy would have been doing better and the value of that currency would slowly be going upward. but it wouldn't give you necessarily a tradable effect. If you were buying euros to put away and the overall euro was good, and you were moving into euros to hold for a longer term investment, that's a different story. But we're trading short-term trades. Now, you have to remember that the markets are very fickle. And one event now can turn around and be volatile and change the entire asset. And then an hour later, it can reverse in the opposite direction. So imagine all of a sudden you holler out the back door because everything was so good. You holler out to the back door, hey, kiddo, we're going to take you over to the mall and buy you that soccer ball you want. And then we're going to take you to McDonald's for dinner because you did so good. You start getting the house ready to go out and the soccer ball comes through the picture window. Well, there goes dinner, there goes the soccer ball, and now you're mad. There goes your happy, your elated feelings because you told them a billion times not to play on that side of the house. You got to call the handyman, you got to clean up the glass. And so the markets have now reversed themselves. Now, again, by tomorrow morning, when everything's taken over, cleaned up and everything's back to normal again, sure, he missed out on the mall, he missed out on soccer ball, but his report card is still there, being better than expected. So breakfast, you make him a nicer breakfast. You make his favorite meal because he did better than expected. Now, the hard part is building what we call market neutral, market negative, and market positive. These are the prices or the areas around the event that will have a tradable effect on the markets. So let's go back over to my economics calendar. And the thing is, you're not going to master trading in the economics in one day. Okay. Because you have to start watching these events. Now, level 1 events, we don't need to pay any attention to. In a lot of cases, level 2 events are events that are also part of a larger event package. So one report can have a level. I mean, if you ever looked at any of these reports, they're hundreds of pages long. And they have headline events, and then they have section events. Like the US jobs report or the claim account will have the new jobs created. It'll have the hours worked for the month. It'll have the hourly wages, and it'll also have the unemployment number. Okay. Now, there's only one of those that are major, but the other ones, depending on what is going on with the economy, could have an effect. Because, like for instance, in the US right now, unemployment is so low. I'm just trying to clean up so the only event we're looking at on the calendar is the ones we want to focus on. Okay, so now we have next Friday's non-farms payroll report. Now, what you can see here is this report, and let's forget the Baker Hughes one down below here. Actually, let's clean up a little bit more and get rid of that also. There we go. So we have 5 reports that make up, or 5 parts of this report. We have the non-farms payroll, which is red, a level 3. We also have our hourly earnings. Now, hourly earnings isn't always a level 3 event. It is now because our unemployment is so low that we want to be looking at what's crucially important is that the wages are going up. When you have everybody employed but wages aren't going up, that's like a problem Japan has. So we want to see that, because what happened was as jobs were starting to get created, a lot of people that are unemployed got jobs, but they weren't in necessarily their field or anywhere near the salaries they used to get, or their wages weren't increasing. So right now, that's crucially important. We were looking at just recently average hourly earnings month over month, which is a second level event. And right now, the unemployment rate is so low, 3.9% in the US is like the lowest unemployment goes, that even if it goes up or down 1/10 of a point, it's not going to make any effect on the markets. But we have these 5 events coming up. So we can only analyze one, or what's called the top level event. We have to add these into and take these account for, but we can't do, we can only do one major event. So the first thing we want to do is look at, we're expecting 180,000 jobs. So we have to figure out, and it can only be an estimate, it can only be a guesstimate of what on either side of this report would be affect the markets. So we could say anything from 170 to 190,000, which is a big variable, but we could say this is market neutral. It doesn't have enough effect to really freak out the markets up or down. Anything below 170 would be market negative and would be what we consider a bad report. Anything over 190 would be a market positive event. Well, that sounds pretty simple, doesn't it? Because we're not predicting how far an asset's going to move. What we're predicting is, or predicating is, will it have a market effect? But this is only the first step, because now we have to consider what I call defined as bumps. They're little pieces of plus or minuses. So the first thing is we want to look at the previous. If the previous was better or worse than expected, we need to say whatever this is, it bumps it either a plus or a minus direction. So that means if this report came in, say hypothetically, at 185, well, that's in the market, the high end of the market neutral. But if we had an upward revision, that bumped it over to a market positive event. If it was a downward revision, okay, it would move it over, but it was so deep in towards the neutral zone, it would have stayed in what we could say still neutral. Then we have to then look at each of the subsequent events, adding on bumps one way or the other. So in other words, if unemployment came in where it was expected, doesn't have any effect. If it was a little bit higher, a little bit lower, it would bump, but push it. So if you had lots of bumps, if the jobs report was at 185 and we had a revision upward, that pushed it into plus. And then we had a jump, a better than expected hourly earnings, that would push it farther than positive. But if it was 185 and we had an upward revision to the previous to push into market positive territory, but we had a pretty bad or low estimation on the hourly earnings rate, that would push it back into the market neutral range. Okay, and that's what you have to do. You have to figure out where that overall report is when it's all released. Okay, is it overall, and you need it to be, and the reason that market positive is so far over here, is you need it to have a tradable effect on the markets. Now, once you've done that, you can do this weeks ahead of time. You can do your research. You know, the consensus of the projection is released about a week ahead of time. So you can sit down ahead of time and put it all in an Excel spreadsheet and lay it out and look at the charts and look how they were last time. Look what assets responded when you had a big miss or a big plus. Okay. And figure it out, because then you have to figure out how you're going to trade. And that's, again, a personal strategy, because you can either decide, I'm going to trade the volatility and I'm going to, you know, if it comes in market positive, I'm going to trade the euro US dollar to go up or down, and I'm going to make my trade instantly. You can combine it with support and resistance zones and say, okay, if the market's market positive, if the euro climbs above the support zone, I'm going to trade it to go up. Or you can wait for 2 hours for all the volatility to go out and then trade the euro to go up. So the course is yours. Okay. There are all different types of strategies, but what it is you have to figure out, say this report is the most important report in the marketplace. Okay, it's the most watched, it causes the most volatility. It's also, when you're trying to trade at the report, it causes so much volatility, you have to have a very precise strategy. Now, the other thing is, you could have looked at other factors to determine if this report's going to be good or bad, and traded the asset before the report. Because when you do your research, you can find out that there are lots of reports that are released leading up to this. Like on the Wednesday before, we have the ADP jobs report. We have our industrial production report, which also shows manufacturing employment by manufacturers. There's many ways that you can predict, using other data that's released throughout the month, what this report will be. And then you can trade the asset before this report because you think the report's going to be good, or you can trade it the other way. But you have to decide how you're going to play it. But the first thing I would recommend is, since all of these reports release over and over the same reports month after month after month after month, and the financial markets are timeless, there's always going to be a trading opportunity, is to start watching the reports, learn what they all are, see how they affect the markets, learn what the reports are, because next month you're going to have a non-farms payroll report, and the month after. Once you've got it down pat, then endeavor to make a trade, or try it on our demo platform. Try it out, to do all your analysis, go through what we did here, do your analysis, then look up and see what effects or where this data comes from and what you can find out ahead of time. Okay. Now, when you go to the filters, or when you go to the event, open up this event, you'll see over here that you can get more information about the non-farms payroll report by clicking here, and the U.S. non-farm. Okay, and it will tell you what other, you can look at what other reports affect it. So you can find out how the ADP jobs report comes out on Wednesday and how this is a leading indicator for this report. You can find all of this out by doing a little bit of market research and getting yourself prepared, because this is one of the few things in the market that you actually know when it's going to happen, why it's going to happen, what assets will be affected when it happens. Okay. You don't have that luxury in most other cases and most other strategies. But again, even if you're not going to trade from economics data, even if you're not a fundamental trader, even though you're not going to trade from the economics counter, no matter how you're trading, you should always be aware of how when these events are coming out, because they can wipe out your good trades in about a second. Or again, they can cause a little bit of volatility that your trade could have been right. You could have been trading gold to go up. Okay, you could be completely right. At the end of the day, gold went up and you could have made thousands of dollars. But the fact is, some report came out in the middle of the day and caused volatility. Mario Draghi made a speech in the middle of the day and you didn't realize he was speaking today. He caused volatility in the markets just for 15 or 20 minutes. Okay, the markets absorbed it. Everything went back to right where it was. But because you didn't have your stop loss placed farther enough away, he caused enough volatility that you got stopped out of a good trade. So remember, keep this in mind. There is lots of information on the internet about using the economics counter. Okay, don't get in these crazy strategies of trading from the news and these knife raising edges. You'll end up losing. Figure out how to do this on your own. Figure out how to analyze the markets. Take time to learn what each of these reports do, how they affect the economy. And again, try it on a demo account for a while. Once you have them down pat, then maybe you want to go off and trade them. But remember, keep an eye on the economics counter. And thank you very much for joining us tonight. Thank you for supporting ETX, and we'll talk to you tomorrow night. Good night now.